So today's Cardinal lesson, we're talking about a product which is not a huge amount of our volume, but where we put it in the right place, it really makes a difference for some people. And that is using an annuity instead of a life insurance policy to get somebody one of these hybrid life long-term care policies. So I want to bring Tom on, and he wants to give a little bit more about this, Tom.
Yeah, so one of the reasons why we're doing this video is we run into situation. There's really two main ones that we use these products. The first one is people who cannot qualify for the other ones that we have done other videos on, which is unfortunately fairly common. They come in, we look through everything, and just it's not going to be available for you. So we use something like this in those situations. And then secondly, we have people that have annuities that they currently own that have some built up gain or accumulated interest inside the annuity. We can use these products to continue deferring the gains. And then eventually, if they need care, to get those benefits tax free. It's a way to avoid taxes on accumulated interest inside annuities. So those are the two main reasons that we use the products that we're going to go into more detail here on the board.
Okay. So the goal here is to get somebody long-term care insurance, is for us to, first, which we do with just about everybody, is to convince them and to convince you today of the importance of preparing for long-term care. And you do this for your family to where you've got a plan together and then you got funding for that plan. So if you reach a point where you can't take care of yourself, you're either going to bring professionals in to your home and get home health care, or after that, it doesn't work anymore. We're going to perhaps go to an assisted living, and that costs a lot of money. And to prepare so that our family doesn't have the burden of figuring out how to pay for this, or we spend our whole estate. So, we have people who say, I'm ready to go. Okay. And then we apply for those products we've talked about on other shows, and then they get turned down. Or we have people that say, Mr. Smith, you can't get this policy, but Mrs. Smith can, of those other products. And so we get her all set up. We put a lump sum in there, but then what are we going to do for him? And this is a consideration. So, which is using an annuity as the basis, or the lump sum goes into an annuity, and then there is long-term care protection beyond the amount that you put in, significantly beyond the amount that you put in. And so voila, we got long-term care. And so the health underwriting on all three of these products is less stringent than they are on the traditional long-term care or the hybrid long-term care that involves life insurance. So the questions are easier. Or when they give certain answers to the questions, they're more tolerant of some particular condition. So the second place that these products come in is when we run into people that already have annuities. And a lot of these people are in their 70s, some are in their 60s, some are in their 80s, and they've got an annuity, and the annuity has significant gains that they've never paid taxes on. And the money's just sitting there. That's one of the beauty of annuities, is you just put it there. You don't have to mess with it. It grows. You don't have to pay taxes on the interest. But ultimately, what are you going to use this for? I mean, ultimately, somebody's going to pay taxes. And at the wrong time, it could be a large amount. So when we run into that with some people, we use an annuity, and these could be otherwise healthy people. So, but they've got this money, part of it's pre-tax, part of it's post-tax, but it's the pre-tax part, the growth and the interest that they're wanting to use in a more efficient manner. And so we use that as the basis for the lump sum for the policy, and then we can purchase an annuity that pays substantially more for long-term care. Okay? Now, I want to bring Tom back on, and we want to talk about specifically the three annuities that we use in these situations. So you want to go over these a little bit, Tom?
Yeah, sure. And so you can see them on the board. They're kind of in different columns. In the show notes, and we'll look at those in a second. But in the show notes, we have actual illustrations that are represented on the board. We're not going to spend a lot of time in the show notes today because they're quite lengthy. But if you want more information, they will be there so you can get them. But the first column is we use this company a lot on their life insurance product, the Asset Care, but they have an annuity care product as well. So it's One America, it's annuity care. And what's nice about this product compared to the other two is it can use IRA money and non-IRA money. So the other two, we'll get to those in a second, but they can only use after-tax money that's not in an IRA, whereas One America can utilize IRA money. And so a lot of times we're using this product in a situation where all their money might be in IRAs, or the significant money is in IRAs. And so this is the one that we look at oftentimes, but it can also accept non-qualified money. The other difference, without getting too specifics into the details, is there is an ongoing cost for an extension rider, which will extend the benefits out past when your money's gone. So, Hans, I don't know if you want to talk a little bit about sort of I don't know how in detail we want to get into the policies here.
Well, we're going to do that in a sec, but let's go over the three policies. So we're talking about the annuity care. The next one is the ForCare from Global Atlantic, which used to be Forethought Insurance, life insurance company. I think maybe it is in the background, but Global Atlantic is the insurer. And the ForCare has been around a long time, and they're going to take certain people that the other products aren't going to take. And then the third one is a relatively new product, and this is the one that is really only in about 30 states now. So you're going to have some of you are going to be a little disappointed when you call us, say, I'm interested in this, and then you find out it's not in your state yet. You keep seeing new states come in every month. So, but for the most part, these products are available everywhere but New York and maybe another state or two that they're missing. So those are the three products, and we have different reasons or different situations of clients that one of these will fit better than the other two for some people. So I want to bring up the show notes, and I want to show you that I'm going to show you some numbers of long-term care benefit that these things will generate, and those are all supported in the show notes. So I want Tom to just bring the show notes online for a second, talk about them.
Yeah, and so these show notes, you can find them on our website or in the link below the video, but they're going to go into a lot more detail than what's on the board. So, I'm going to flip through them fairly quickly, just because I don't want to spend too long studying these in each individual one. But the first one is the One America. So that's this first illustration here. I'm going to scroll down to sort of the summary page, which is going to support a lot of the numbers that are on the board. And there's some more details later up here. But essentially this, and we've shown all of these illustrations using $100,000. You can clearly take more than 100,000. It's very linear. You put double the amount of money in, you put 200,000 in, you get double the benefits. So just know it's not limited to 100,000. But this particular policy we have illustrated. So you put 100,000 in, it pays starting from day one, $2,800, almost $2,900 a month worth of benefits, and then it will provide that benefit for 72 months, up to 6 years. And so one of the earlier pages here, and you'll see it shown on the board here, is the benefit at age 80 is right here, 52.20. So that money does grow. There is an interest rate that it earns inside the policy. So the monthly benefit does increase as you hold the policy. So, but that, again, all those numbers are on the board. The next one that's on the board is the Global Atlantic policy. This one is unique in the sense, and you'll see this in the show notes, but there's a premier rate and a standard rate. So there's the benefits are different depending on where you fall in terms of the underwriting standpoint. Again, the premier rate, you put the same 100,000 in. Initially, it's a higher benefit than the One America. It's $4,200 a month, starting at day one. And then it depending on the growth, it could be higher, depending on the age. I think on the board at age 80,
66.28.
66.28 supported here. That's a non-guaranteed. Both of those are non-guaranteed, so it depends a little bit on the growth of the contract. But we'll get into, if you're interested, we can get more into the details.
Well, and the next illustration just shows if you don't qualify for Premier, you qualify for Standard, you obviously get less.
Yeah.
because you're not as healthy and for the insurance company. And so let's move on to the bridge one.
Yeah.
And there's three of the bridge ones.
And the one other thing I'll point out right before we move on is both the One America and the Global Atlantic can cover couples. You can have two people insured under a single policy. So we've in the illustrations we've shown it covering one person, but both of them can accept couples. The bridge policy, and this is the newer one, this has to be a single person. You can't buy this jointly together. But to Hans's point, again, there's three different illustrations. This comes in, it depends on the underwriting, and Hans will talk a little more about that here in a second. But at the preferred rate, again, we're showing 100,000 going in, and it starts out initial monthly benefit of $2,226 a month, and then it grows at age 80 is 61, 69 in the illustration, and so that's sort of their best rate class. If we scroll down to like sort of the next level down, standard, looking at the same 100,000, the initial monthly benefit is 1977. Age 80 is 4262. So you can see, depending on health wise where you are, it will pay less benefits. But this standard rate will take a lot of people. So even if you have some conditions, don't let that scare you off. Again, back to the initial point of why we're doing this video, this policy will take people that other ones won't. And then the final one is that sort of the lowest rate possible, where the monthly benefit is $1,756, and then the age 80 is like $2,804.
Well, let's point out everyone qualifies for this. So you could have somebody that's actually using care now and they could purchase this. So, what I'm going to do is give you a little idea of why we would use one of these over the other. Okay, so why do we need three? And what I would tell you, what they all three have in common is they have this easier health underwriting, because what you're doing is if you go in a facility or you get home health care and you start collecting this monthly amount for several years, what you're doing is you're using your own money first. So they're just simply giving back to you the money that you put in there in the first place, plus some of the interest. So the insurance company is a bit protected for the first 2 years of care or thereabouts, or 2.5 years, because they're just giving you back your own money. And where the insurance company has risk is beyond 2 years. Now you're going to still, like on this one, you're going to collect for 72 months, this one 72 months, this one 60 months. So the back end of a claim, which is what you're really concerned about, is this 50, 60, 80, $100,000 a year of expense for long-term care going on for several years. So in the beginning, they're just giving you back your own money. And then later, you're into their money, or they're paying out like an insurance policy where they're just paying it out of their funds. And then you say, well, okay, now I got it. So I'm just getting back my own money, but you're getting back your own money tax-free because it's paid out as a long-term care benefit. So that's where you come into the people that maybe have an annuity that they put $60,000 in 15 years ago and it's grown to $150,000, and so they got $90,000 of tax-free or tax-deferred interest built up in the thing. They could roll it over into one of these and then leave it there till they collect for long-term care, and those benefits will all come tax-free to them. So there's a lot of places that we use these things. So why would we use one over the other? Is this one has the capability to give you the most benefits because it has an extension rider. So if you can qualify for this, then you can purchase the extension rider. And so we have an otherwise uninsurable person that could set up an annuity, it's going to grow, and then use their own money for long-term care. But when their money runs out, essentially, they have substantial insurance for many years beyond that. You could make it longer than 72 months. Okay, so this one also asks, have you been turned down for long-term care insurance? So this company and this company, if you've been turned down somewhere else, you have to wait a year to apply for either one of these, because they don't want just other companies' turn downs just all coming to them to buy the thing. With this one, we can go right away to them and apply. They don't have such a question. So when you get over to the for-care, where this one is really good, is if you've got a condition that isn't in their first set of questions, so they have some things, do you have to use a walker, wheelchair? Do you have Alzheimer's? Do you have some very severe? So they have some questions that if you answer any of them yes, you can't apply for this. Same as this is, so if you can answer those questions all no, but yet you've got something which is pretty serious and it's caused you to not be able to get one of these other policies, you can come in here and buy this. And you can also cover husband and wife on this policy. It's going to pay out a little bit less, but it is going to cover both of you. And so that's really the plus with this. And this one has 2 rate classes. So they have the first questions, which say, no, you can't get this. Then they got the second set of questions. If you answer them yes, you can still get it, but you get it at the standard rate. And this one, if you can answer all the questions no, then you get the premier rate. Okay. And then you come over to this product, and I'm just trying to give you the generals. I'm not giving everything specifically. This one has 3 rate classes. The best rate means, and this one doesn't do as much health underwriting as they do lifestyle underwriting. They don't write to your doctor. They don't get your medical records. They don't give you an exam. They do a video interview, and they're going to give you a memory test, one of those things where they're going to ask you some questions. Then the second thing they're going to do is they're going to have you get up, turn around, walk, stand on one leg, see how long you can do that. It sounds kind of funny, but they're more looking for people that have mobility, that can get around. They know they got their wits about them. And you could have somebody that had a form of cancer a year or 2 ago, or even has it now, but yet they can pass all the lifestyle stuff. They could conceivably get into this class. So this is less health underwriting, more memory underwriting, and lifestyle underwriting. Like if you can get about your world and socialize and do things for yourself, they're going to put you in the best class for this. Then they have this middle class of underwriting where maybe you don't do so well at some of those things, or you've got certain conditions that they ask you and you admit to, then they're going to put you in the middle of the road class. And I don't want you to dismiss the rating that everyone gets, because we can have somebody that is just flat not insurable for long-term care. And when you look at it from that perspective, that they can get nothing else, and they've got some non-qualified funds that they could put into this. And, that's really the insurance industry saying, we think you're going to use this. And this still doesn't look too bad for somebody that has no other options. So I wouldn't rule out any of them. We can get together and talk about all 3 of them. Now, the point I wanted to make is with the annuity, these are like any other annuity. You're going to put your money in there. It's basically tied up for 10 years. So you don't want to be putting money in there to these things that you're going to need for other purposes. So I just want to be clear on that. But you put it in there, and it's going to get credited with interest every year, unless, on some of these, they have a way where they're tied to an index, and there could be a year where you get 0, but that would be a year where people lost money on investments. So you're going to get your interest credit, and it's going to build up in value. And if you never use the thing, that annuity is going to go to your heirs after your death, just like any other annuity. And the insurance premium or the insurance cost within any of these annuities is just taken out of a piece of the interest. So these things are going to grow. If you never use them, you're going to be better off for having the security. If you do use them, you're using your own money first, but then you're going to get into the insurance company. And if you're in there using care for a long time, you're going to get really into the insurance company's money. And then, that's that's just people live happily ever after. So, um, in any case, this is an option. And if you're in this, or you come into us for financial planning, and we convince you to apply for long-term care, and if you got some health conditions, you might end up getting presented one of these things here. So I want to bring Tom back on, and we want to talk a little bit about the 7 worries and which ones that we've touched on today. It's obviously about long-term care. It's about IRA 401k, because you can use IRA money for this one. You lose some of the tax benefits, but if that's all you got for a lump sum, it can work. Um, then we talked about income, which is paying for your long-term care. We talked about your estate, and we obviously talked about taxes. So I'm Hans Scheil,
And I'm Tom Griffith.
and we thank you for listening.
Thank you.